Welcome back, ladies and gentlemen. Today we're going to be going over Chapter 11, which looks at foreign exchange. So we're starting to look at different currency markets. We'll go over foreign exchange quotes, as well as the market for the exchange rate. So we'll look at appreciation, depreciation, and how that intertwines to this new model. So when we talk about foreign exchange market, it's often referred as it's an organizational setting which individuals, businesses, and governments and banks buy and sell foreign currencies and other forms of debt instruments. So it's one of the largest and most liquid market in the world because, again, you're trading currencies, and currencies is a form of cash and so forth. And it's dominated by four specific currencies: the US dollar, the euro, Japanese yen, and the British pound. So those four main ones we focus on. And roughly, foreign exchange transactions is around $5 trillion a day, which is a huge amount. And then individual traders, so individuals that trade these currencies, is anywhere from 200 to 500 million. So we'll look at different quoted prices, and these prices can fluctuate from minute to minute, hour by hour, and sometimes some of the most active exchange rates can change up to 18,000 times during a single day. So there's a huge fluctuation. Now, there's three of the largest markets are located in London, New York, and Tokyo. And the market has three levels. So the first level, transactions between commercial banks and commercial customers. So for example, if you're going in to the bank and you want to basically you want to convert your currency because you're going on a trip, whatever it may be, you can do it through them. Also, is a domestic interbank market, so it's conducted through brokers, and then also active trading in the foreign exchange with banks overseas. So banks typically engage in three types of foreign exchange transactions: spot, forward, and swap. So these are things you're going to need to know for your exam. So spot market is where foreign exchange is bought and sold for delivery immediately. So something you can go out and the transaction is much faster. So this is an outright purchase or sale of currency now, as in on the spot. That's why they call it spot transaction. Now, spot dealing, simplest way to meet currency requirements, but carries high risk of exchange rate fluctuations because there's no uncertainty of the rate until the transaction is complete. So again, this rate is fluctuating constantly because of different factors. They're sold on this market, and we'll talk a little bit more about that in a bit. All right, and then banks typically engage in three types of foreign exchange transactions. Again, we're going to talk about spot, forward, and swap. Forward transactions, the definition of this is receiving or paying an amount of foreign currency on a specific date in the future, months to years from now. So basically, you're agreeing to purchase something and you get something in return X amount of time in the future. Now, there's a fixed exchange rate. So spot is on the spot, whatever it may be. Fixed is you're locking in on a certain exchange rate and you're promised to get this in a future time period. Now, this protects against unfavorable movements in exchange rate, but will not allow gains to be made should the exchange rate move in one's favor. So basically, let's just say you're getting a better deal right now. Let's say your currency increases in value in the future. It's not going to affect you because it's a fixed exchange rate. You're agreeing upon one specific exchange rate. Now, the forward market, this is a foreign exchange bought and sold for delivery at a future date. And this exists mainly for widely traded currencies. So again, the dollar, yen, the pound. So those are the ones we're going to focus on. Currency swaps, it's a conversion of one currency to another currency at a point in time. So the agreement to reconvert it back to the original currency at a specific time in the future. So we'll talk about this in a bit as well. We have rates of both exchange rates agreed in advance. It also involves a single transaction in which traders agree to pay or receive a stipulated amount of currencies at a specific date, or a specific rate, sorry. Okay, so for example, we're going to talk about a couple of the different ones. So spot transactions, forward transactions, and the foreign exchange option. So we'll first go through an example of a spot transaction. A couple things that you need to know about this as well. It's usually a 2-day period in which this takes place. So you make the call, you want to purchase a currency, and then it's a 2-day period in which you get those, so 2 working days. So an example would be, let's say a trader calls another trader and asks for the price of a currency. Let's just say the euro. This call expresses only a potential interest in a deal without the caller indicating whether he or she wants to buy or sell. So the first thing, you call to inquire. The second trader provides the first trader with prices of both buying and selling. So if you want to purchase or sell, again, it's based on the interaction. When traders agree to do business, one will send euros and the other will send, let's just say, dollars. And then the payment is actually made 2 days later. Again, what I was talking about before, immediate delivery. It takes 2 days for this transaction to process. Okay, so a forward transaction, this, for an example, it would be a buyer and seller. They're basically locked into a contract at a fixed price, and they can't be affected by any changes in the market exchange rates. So this tool allows market participants to plan more safely because they know in advance what their foreign exchange will cost. So this allows them to avoid immediate outlays of cash. Basically, in the future, you're saying, okay, I'm going to purchase this at this point, and you know what to expect at that point in time. So here, the last one we're going to go over, is the foreign exchange options. So the example is going to be, let's just say, suppose a U.S. company needs to buy 15 million Swiss francs for a 3-month investment in Switzerland. So a U.S. company wants to buy currency from the Swiss in terms of investing into Switzerland. So it may agree on a rate of 1.5 francs to a dollar and swap 10 million with a company willing to swap 15 million francs for 3 months. So basically, we have $10 million, but the Swiss businesses or Swiss firms, they're not going to accept dollars. We need to convert this into their currency. So we use their exchange rate. Their exchange rate is 1.5 francs to a dollar. So it costs 1.5 francs to have a dollar. So we convert our money. So we swap this money. So after 3 months, the U.S. company returns the 15 million francs to the other company and gets back 10 million with adjustments made for interest rate differentials. So it's not just, okay, we're going to switch 10 million for 15 Swiss francs. It's going to be, we're still going to pay interest. There's going to be a benefit to this for both parties. The U.S. company wants to invest, and then the Swiss company or the Swiss bank that lends, they get something in return in the form of an interest rate. So here we have a breakdown of different types of instruments used and the percentage. So this is global distribution of foreign exchange transactions in 2016. So you can see a majority of stuff that takes place is the foreign exchange currency swap, where we just, the example I just provided, at 48.6%. And then spot transactions, those are the most immediate, the fastest way with the 2-day period is 32.6. Forward transactions, that's a mutual agreement at a fixed exchange rate in the future. And we'll talk about foreign exchange options later on. All right, so the exchange rate. We're going to look at the foreign exchange quotations. This is something that you are going to need to know. So the exchange rate is basically the price of one currency in terms of another. So number of units of foreign currency required to purchase 1 unit of domestic currency. So we'll look at a couple different examples. The exchange rate is reported. So there's a mid-range between bid and offer prices. So if you bid for something and then the actual offer price, there's a difference. And this is usually reported in newspapers as well as online. There's different ways to access all this stuff. So we're going to go over an example. All right, so here we have a table. This is from April 25th, 2017. It was a Tuesday. And you have the exchange rate on that specific day. So you have your country and your currency, and then you have in USD and then per USD. Now these are important to know, and we'll talk about why. So for our example specifically, I want you guys to focus on the Australian dollar. So we're looking at these two numbers. So 0.7536 and then 1.3270. So when you see in US dollars, this meaning dollars to purchase 1 Australian dollar. Again, we're talking in terms of USD is United States dollars. Per USD is meaning Australian dollars to purchase 1 US dollar. So in USD, this is how many dollars, US dollars, it takes to buy 1 Australian dollar. Per USD is how much of this foreign currency is needed to purchase 1 US dollar. So for Australia, in USD, it costs us 75 cents to purchase 1 Australian dollar. Now, per USD, it costs 1.3270 Australian dollars to purchase 1 US dollar. Again, you can do that with the peso here, you can do that with the won, and you can also do it with the pound. It's the same concept. In USD is dollars to purchase Australian dollars or your domestic currency in order to purchase a foreign currency. Per US dollars is foreign currency in terms of domestic currency. So in our case, we're using the US dollar. So just be comfortable with that. Make sure you expect that on the next test. Okay, so now what we're going to talk about is currency depreciation, currency appreciation, and then the cross exchange rate. So, before we go there, so this foreign currency quotations, this is basically the amount of how much banks are willing to trade with each other, and this market is based on banks willing and able to sell or buy at more than $1 million. So they have to buy more than $1 million of currency. That's when these trades take place. Okay, so depreciation, appreciation, we've talked about this earlier on in the semester. Currency depreciation is more units of a nation's currency required to purchase a unit of foreign currency. So basically, if it costs us more US dollars to purchase a different currency, that means our value has been depreciated. Our currency is not as strong. Currency appreciation is there's fewer units of nation's currency required to purchase a unit of foreign currency. Basically, it's going to cost us less as Americans to purchase a foreign currency because our dollar is stronger. Now, the key thing to remember here is when your currency depreciates or appreciates, the other currency that we're looking at, it's going to do the opposite. So for this first one, if the United States dollar, it depreciates, that means whatever the other currency we're looking at is going to appreciate. So there's an inverse relationship. So if our currency is appreciating, and we're comparing this to the Australian dollar, if the US dollar appreciates, that means the Australian dollar depreciates. If the US dollar depreciates, the Australian dollar appreciates. Again, inverse relationship here. Okay. Now the cross exchange rate, this is the exchange rate between any two currencies, such as the Swiss franc and the British pound, and we can conduct this if we add just this in terms of US dollars, so we can still calculate the cross exchange rate. Basically, you derive a third currency exchange rate using two parties that are stated. So in this case, if we wanted to find out the cost, we could find out the dollar cost of a pound and then also the dollar cost of a Swiss franc. You would divide those two and then you would get francs per pound. Basically, it's just calculating what the exchange rate is given two in terms of dollars. Okay. The forward and future markets, we're going to talk about this a little bit. The foreign exchange can be bought and sold for deliver or immediately on the spot market or in the future market. So the future market is forward. Again, you're setting a set time period where you're going to make a transaction at a certain exchange rate. The future market, this party agrees to future exchanges of currency and set applicable exchange rates in advance. Only some leading currencies are traded. Again, it's got to have some strong value. You're not going to want to trade a currency that's not widely accepted. So that's why it's the one that's mostly used is the dollar, the pound, the euro, and so forth. And then trading takes place in a standardized contract amounts in specific geographic locations. Okay, so this is a forward contract versus a future contract. So a forward contract is issued by the bank, future contract, the international monetary market, and we'll talk about that in the next slide. Trading is over the counter by telephone for a forward contract. Trading for a future contract is on the market floor of the IMM. The contract size, again, different between these two groups. Date of delivery is negotiable for a forward contract. Future contracts are only on particular dates. So this is what we're going to be looking at. So the IMM is also called the Chicago Mercantile Exchange in 1972. It's an extension of commodities futures market. So if you know what futures or commodity markets are, so if you want to purchase oil, you can purchase oil at a set date. It's going to mature. If you don't sell and you might be stuck with all this oil, a very similar thing that's happening to oil right now. The size of each contract is on the same line as the currency's name and country. And then the first column is the maturity month. So we'll kind of go over it. Here we have foreign currency futures. This is April 24, 2017. You have the month that it's going to mature. This is the price that it opens at. So the price it opens at is the price at which currency first sells when the market opens in the morning. The high is the highest price for that specific day. The low is the lowest price. The settle is the contract's closing price for that day. So whatever this price is, this is what you're going to get. It opened up at 90, 98.4. The high was 91.26. And at the end of the day, it was 91.18. And then the change is basically telling you the difference between one day and the next. So here we have the open, high, low, and settle. The change is compared today's closing price with a closing price as listed in previous day's paper. So if it's a positive value, that means prices ended higher. If it's a negative value, prices ended lower. Very similar to normal markets that we look at. Open interest is the total number of contracts outstanding. So here, the number of contracts outstanding, you see the amount. All right, so options, foreign currency options. These are agreements between holder, which is the buyer, and the writer. The writer is the seller. Holder has a right, but no obligation to buy or sell financial instruments at any time through a specific date. The writer, who is the seller, has the obligation to fulfill a transaction. Now, this is used by firms seeking to hedge against rate risk, also used by speculators seeking profit. So options holder has a right to buy or sell fixed amount of foreign currency exchange at prearranged price within specific period, and you can choose which exchange rate to guarantee and length of contract. You also have a call option. Call option is basically giving holder the right to buy foreign currency at a specific price. You have a put option. This gives the holder the right to sell a currency at a specific price. The strike price is a price at which the option can be exercised. A premium is the fee received by the seller of options contracts. So this is where you make your money. Okay, so this is the biggest part of Chapter 11 that I really want to get into is the demand for foreign currency exchange. So here we're going to have a supply and demand for foreign currency. So people who demand it, people who supply it. And we're going to use the United States and the UK. So the exchange rates in the free market are determined by supply and demand. Demand is derived by, it's derived demand, so it's driven by foreign's demand for domestic goods and assets. So if a foreign country wants to purchase our products, or they want a lot more of our products, they're going to be demanding more, and vice versa. And then this corresponds to debit items in a country's balance of payments. Just make sure you remember that for your quiz. And this varies inversely with price. So again, it's downward sloping. Our supply of foreign currency exchange, it's the amount of foreign exchange offered in a market, and this increases at various exchange rates, holding all other factors equal. So it's an upward sloping curve. Here we have our curve. So you have your supply, you have your demand. Where it intersects, this is your equilibrium exchange. This is where you want to be. Anything past this point is going to be either a appreciation in your currency or a depreciation. So here we're looking at dollars in terms of pounds. So our equilibrium exchange is at $2. If the price increases, so this is dollars per pound. If the price increases, the dollar depreciates, meaning we have to spend much more of our US dollars buying a pound. So if the price goes from 2 to 3, you see depreciation. Again, it's based on your foreign currency exchange equilibrium. That means the more we spend, the more US dollars we need to purchase a 1 pound increases, that means your dollar is weaker. Now, if our dollar exchange rate falls below our equilibrium, meaning it costs less, so let's just say it went from $2 to $1. Now it costs less money to purchase our foreign currency, so our dollar appreciates. So we can even do it to an extreme. If it costs us 50 cents to purchase 1 pound, our dollar appreciates and the pound depreciates. All right, so we're just going to go over some of these. So the higher dollar per pound exchange rate, the more expensive to purchase foreign currency. Again, it costs us much more of our domestic currency to buy this foreign currency, so there's a lower quantity demanded of pounds. So on our x-axis, we have billions of pounds. On our y is our dollar per pound ratio. So the higher dollar per pound, so the higher value, the less we want of these other products because it's much more expensive. And the result is we're going to decrease imports from the UK. We decrease them because their products are much more expensive and we don't want to purchase those. Now, the lower the dollar per pound, so if it costs us less to purchase their currency, so 50 cents to, let's just say, $1, it's less expensive to purchase their currency. We have a higher quantity demanded of pounds. So at this point, we want much more, and we're going to increase imports from the UK, meaning their products are going to be much, much cheaper. Okay, so in terms of supply, the higher dollar per pound, British want more US products because their currency is stronger. So the higher dollar per pound, that means more Americans have to pay much more to get their currency. That means the British pound is much stronger than the dollar. Again, the dollar, we're looking at dollars in terms of pounds. So if the dollar depreciates, the other currency is going to appreciate. Their value is much stronger. So in this case, they want to provide much more pounds to the market because the United States products in this case are cheaper. So this increases exports from the USA. So this is good for the United States because we're exporting, but it's also bad because we're not reaping some of the benefits as well as producing them within our own borders and producing. So we've talked about this in the beginning of the semester. Now the lower dollar per pound. So basically, if the dollar appreciates and the pound depreciates, the British want less US products because their currency is weaker. Now, because of this, they're going to provide less pounds to the market. So you'll see it when the dollar appreciates, there's less. And the result of this, there's a decrease of exports from the United States. Decrease in exports because they want to purchase less. So this exchange rate is determined by market forces. So we'll talk about increase and decrease in demand. Increase in demand is a rightward shift. Decrease in demand is a leftward shift. And from there, you should be able to determine what happens to the exchange rate. So if our demand increased, this is our new equilibrium. What happened? The dollar depreciates. Basically, we're purchasing, it costs us more to purchase these products. Now, if our demand were to decrease, our dollar appreciates. And we'll talk about different examples. And we can do the same thing with our supply as well. So if our supply increase, that means our dollar appreciates. If our supply decreases, the dollar depreciates. So just be aware of which currency we're looking at. In this case, it's dollars per pound, and then it's the dollar depreciation, dollar appreciation. The only thing you would switch is what currency you're looking at, and it's still the same concept. So we just talked about supply as well. Okay, so there's 4 shift factors. These are shift factors that you're going to need to know. I'm not going to draw the specific examples. I assume that you guys know what an increase in demand and decrease in demand are. It's just based on that same graph. So the 4 shift factors are price level, productivity, preference, and trade barriers. We're going to go through each of them. So if the U.S. price level increases, so again, we're looking at the U.S. market. If the U.S. price level increases, U.S. consumers want lower priced goods from the UK. Now, because of this, our demand is going to increase because we need to purchase these foreign items with their currency. So demand increases, so we need more pounds to purchase products. Now, if our demand increases, that's going to be a rightward shift. And what you should see, and we'll look back at our graph, if our demand increases, our dollar depreciates. Now, our supply in this case decreases because the UK wants to buy less US goods due to higher prices. So again, there's two effects. If price levels increase, the demand is going to increase because we want cheaper products from this other country, but the supply of this foreign currency is going to decrease because they want less of our products due to our higher prices. Again, that's the key thing here. So if you were to do it in reverse, if US price levels decreased, the demand would decrease and also supply would increase. So again, just be able to track these points. The next one is US productivity increases. So if we're more efficient at producing something, the price is going to be lower. So nations export increases and imports decrease. Our exports increase because we have the lowest price. We're always going to assume productivity is going to reduce your price. And our imports are going to decrease because we're much more efficient at producing. So there's going to be a decrease in demand for foreign currency. And there's going to be an increase in supply of foreign currency because the UK wants much more of our US products. So productivity and price level use supply and demand as shift factors combined. Now, if US productivity decreased, again, it would be different. So nation exports would decrease, imports would increase. There'd be an increase in demand for foreign currency, and there would be a decrease in supply of foreign currency. So again, be able to work both ways. Okay, so the other two shift factors is preference and trade barriers. So preference, if US demands more UK goods, our dollar is going to depreciate. If we want more UK goods because it's cheaper or better quality, whatever it may be an increase in demand. If the UK demands more of our US goods, our dollar is going to appreciate because, again, this is your supply. The people who supply this foreign currency is those foreigners. People who demand are the domestic consumers. Okay, and the last one is trade barriers. So let's just say the US imposes tariffs on the UK, thus decreasing demand. Basically, we're saying we're not going to trade with them. It's harder to trade, so we demand less, and our dollar is going to appreciate based on our model. Now, let's just say we open up our economy. Our demand's going to increase, so our exchange rate's going to go up, our dollar will depreciate, so there's different ways you can look at this as well. Okay, so the next thing I want you guys to do is in the comment section, so if you're watching this through Beachboard or another site, just open it up on YouTube, and I want you to answer in the comment section below. So what's going to happen to the exchange rate if there's a decrease in productivity? I want you to just answer the questions in the comment sections. Will the dollar appreciate or depreciate? And then provide an explanation describing which curve shift and why. In doing so, you'll get a couple extra points. Again, I recommend to do this. We're going into the final. Just pad your stats a little, and you should be good. So again, answer in the comment sections below. Do not email me it. It has to be in the comment section. Okay. So there's advantages and disadvantages of weakening the dollar. So this is going to be the last thing that we look at. So the advantages, so if our dollar appreciates, the U.S. consumer sees lower prices on foreign goods. We also see lower prices on foreign goods. These help keep U.S. inflation low. The consumers obviously benefit when they travel to these foreign countries because they can purchase much more. The disadvantages, the U.S. exporting firms find it harder to compete in foreign markets. Again, their price levels are higher. No one's going to want to purchase their products. U.S. firms in import competing markets find it harder to compete with lower priced foreign goods. So we've talked about this, higher price levels in different areas. And then foreign tourists find it more expensive to visit the United States. So we see tourism decrease. Now, when we depreciate our dollar, the advantages are going to be for the U.S. exporting firm because it's easier to sell their goods abroad because they can purchase much more of our products. Their currency is stronger than ours. Now, the firms in the U.S. have less competitive pressure to keep prices low. More tourists visit the United States, again, increasing our tourism. It's another industry that we have. Disadvantages, U.S. consumers face higher prices on foreign goods. Higher prices on foreign goods contribute to higher inflation in the U.S., and then U.S. consumers find it harder traveling abroad because it's much more costly. Again, think of times when you've traveled to a country that has an exchange rate in favor to the dollar. So if the dollar is stronger than the currency, you can travel pretty comfortably. You can, if anyone's gone to Thailand, if anyone's gone to Mexico or South American countries, or East Asian countries, your dollar goes a long way. You might hear that phrase. That's because our dollar is strong, their currency is weaker. We can purchase much more of their products. As opposed to those individuals from developed or lesser developed countries that come here to vacation, it's going to be much harder. They're going to need a lot more money in order to convert and consume the products that we have. So that's going to be it for this video. Again, I didn't cover every single slide that's available to you, but the stuff I did cover is going to be important. This is going to be my last video for this class. Again, thank you guys for sticking through this. It's been a different journey. A lot of us didn't see this coming, but I applaud you guys for sticking through with this, finishing the semester, and I wish you guys the best of luck. Thank you guys. I will see you guys for the review soon. Thank you.